Bismillahirrahmanirrahim. My name is Mazahir Ali and welcome to another lecture for O-Levels Accounting. The topic that we are going to discuss today is accounting equation. So first of all, we need to understand that what is accounting equation. To understand the answer of this question, there are 2 points that first of all, accounting equation is the most important fundamental of accounting because it forms the basis for statement of comprehensive income and statement of financial position. It forms the basis for SOFP to be more specific. And secondly, it forms the basis or it introduces us to the double entry concept and the concept of duality. The double entry concept or the concept of duality is the most important and the most fundamental and the most basic thing to understand and start accounting. And to further understand double entry, we must understand the accounting equation. To understand the accounting equation, first of all, we need to understand its components. Accounting equation has 3 components. Number 1, assets. Number 2, liabilities, and number 3, equity. To dig deep into these concepts, we will first go for what an asset is. To clearly understand the concept of asset, we will break down the definition into 3 parts. The first part is that asset is a resource that is controlled by an entity. The second part of the definition is that it is obtained or as a result of past events. And the third part is from which a future economic benefit is expected. Now to understand these 3 parts individually, first we will go that what does it mean by a resource controlled by an entity. Now we will understand what does it mean that an asset is a resource controlled by an entity. By controlling a resource, we mean that an entity is able to get economic benefit from that asset and the entity restricts other to get that economic benefit from it. These 2 lines tells us that what does the meaning of controlling a resource is. Now we go to the second part, and that is by using that asset, an entity can have a cash flow, and by cash flow means that any inflow or any gain of any cash or cash equivalent that will be of benefit for the entity. And here we have to understand a point that it is not necessary that an asset must be in physical form. There are 2 types of asset. One is tangible asset and the other is intangible asset. We will discuss these in our further studies, but for now it is only necessary to know that there are tangible and intangible assets. Now we will move to the second part of our definition, that was result of past event. By this we mean that we will consider an asset only when the transaction has been completed and not based on any future intention. For example, if I have an intention to buy something, so I'll not consider it as my asset, and I will only consider it my asset only when I have obtained it. As we studied in our previous lecture, this is an example or the concept of prudence, the ones we discussed in our earlier lectures. And now moving to the third part of what an asset is, expected future economic benefit. By this part of the definition, we mean that an asset is capable of providing economic benefits in the form of cash inflows or cash equivalent inflows in the future. By using an asset for producing goods or providing services, we will get a revenue from the customers, and that will contribute to the inflow or the economic benefit of our entity. Here we will understand two more concepts, that asset has two main types. The first one is non-current assets and the second type current assets. Non-current assets are those assets which have a lifetime of at least more than a year. We can say that any asset that provides economic benefit in the long term. And secondly, the current assets are totally opposite, that they have a life of almost maximum a year. And these types of assets are regarded in the short term. For now, we have discussed what an asset is, and we broke the definition into three parts and clearly understood what each part meant, and then we discussed non-current assets and current assets. Now we will move to the second concept that we discussed earlier, is liability. As we did for the asset, we will break down the definition into three parts. Liability is a present obligation of an entity that arises of past events, and the third part, settlement of which is expected in an outflow of resources embodying economic benefits. Now we will understand what these parts mean. So liability is an obligation, and by obligation we mean that anything which is practically unavoidable by the entity. Present obligation can be enforced by two main things. The first one is that it is imposed on us legally. That can be due to a binding contract or any statutory requirement. And the second one is due to past practices or any statement. We will understand this by an example, that if our entity has a past practice of compensating the customer for delivery of any faulty goods, so if a customer now comes and claims that he have been delivered faulty goods, our entity will have to compensate because we have been doing it in the past. Or if we give any statement officially and publicly that we will be compensating the customers, it also creates a hope for them, and it will be our present obligation. Now moving to the second part, that is result of past transaction. Just for the asset we discussed, it is the same for liability, that anything which we are liable will be a result of past transaction. For example, if I have deal with a supplier that he'll deliver me goods on, for example, say 1st of September 2020. So I'll be liable to pay the amount only after the delivery of goods. Before the date of 1st September, I am not legally liable to pay the amount. I am only liable when I have signed a contract that we discussed in the previous point, that we agreed on some terms that the supplier will deliver me goods on 1st September and I have to pay him before that date. So then only I'll be liable. Elsewise, I'll be only liable if the transaction has occurred in the past. Now discussing the third point, and the third point is expected outflow of resources. To understand this point, we will again take an example, that if I am liable to pay someone, or it is my present obligation as a result of past transaction, and upon settlement of that liability, I'll have to pay the supplier or any other person that I'm liable to pay. I will pay in the form of cash or cash equivalents, and they'll be embodied by some economic benefits, because these cash or cash equivalents are my asset and they are expected to bring me inflow of resources, and if I pay them, so there will be an outflow of resources. As simple as that. And again, a point to be discussed here, that when the liability is based on estimation, such liability is called provision. Okay, so now here we'll again discuss two types of liabilities, which are pretty clear because we have understood the terms non-current liability and current liability. The word non-current refers to long term and the word current refers to short term. Non-current liabilities are to be paid in a period more than 1 year, and current liabilities are to be paid in less than or equal to 1 year. Now we will move to the third and last component of accounting equation, that is equity, whose definition will give us the structure of accounting equation. To understand the concept of equity, we'll have to keep in mind the concept of business entity, that an entity and a business are two separate things. First of all, equity is referred to owed by a business to its owner, and if the amount is owed to others, that is called liability. Another definition or another point is that equity is the residual amount or interest of assets, the residual amount of assets after paying all the liabilities. Equity is also referred to as net asset. So the definition of equity gives us the accounting equation. Equity is equal to assets minus liability, or another way of putting is this equation is that assets is equal to equity plus liability. This equation is referred to as accounting equation, and as we discussed earlier, this gives us the basics for our double entry concept, that is the concept of duality, and also the basis for the formation of statement of financial position. Now that we have clearly understood what asset, what an equity, and what liability is, now we will solve some transactions and see how the accounting equation works. So I have some types of transactions that we'll see how that goes into the accounting equation. So we'll move to the examples. The first example or the first type of transaction we have is introduction of capital. Let's say, for example, Mr. A started a business with capital of rupees 1 million. So how we will show this, or how we will illustrate this transaction into the accounting equation? First of all, we'll write this equation up here. Equity is also referred to as capital, net assets. These all are the name of one thing. So when we brought in a capital of 1 million, first of all, on the right hand side, the capital will be increased by 1 million. Now moving to the second part, the capital will be brought in the form of cash or any cash equivalent, that is our asset. So our asset will be increased by 1 million. So here we can see that left hand side is equal to right hand side, and they always should be equal to illustrate or manifest the concept of duality, that any transaction will have two and equal effects. Moving to the second type of equation, and that is borrowing money or taking a loan. For here we will say that Mr. A takes a loan of rupees 100,000. The illustration and accounting equation of this transaction will be the amount of loan we obtain is in cash or cash equivalents, so our assets will be increased by 100,000, and loan is our liability because it is a present obligation, and the settlement of this loan is expected to have an outflow of resources. So our liability will be increased by 100,000, and again our two sides of the equation are equal. Now moving to the third type of transaction, and that is purchase of asset on cash. For example, Mr. A car worth 700,000. Now we'll see what will be the effect on accounting equation. Here car is our asset, so we'll increase one asset by 700,000, and we paid for the car in form of cash, and there is an outflow of 700,000. In accounting for minus, we use brackets. It means the amount is negative. So there are two types. There is a transaction involving two types of asset. One is car and the other is cash. The inflow of car worth 700,000, and the outflow of is again of 700,000. So the equation will be equal 700,000 minus 700,000 is equal to 0. Moving to the fourth type of transaction that we may see is purchase of asset on credit. So again, Mr. A, he purchases machinery worth 1.5 million. Here comes the accounting equation. So there is an asset and it has amount of 1.5 million, and that is an increase in asset. So we'll write it on this left hand side 1.5 million, and the transaction is based on credit terms. That means it is a liability. So we'll increase liability by 1.5 million, and both the sides are equal now. Moving to the fifth part of equation, here we'll take an example of a purchase where both cash and credit is involved. So we'll say that Mr. A, once again, he purchased some treasury bills worth rupees 500,000, and he paid 300,000 in cash and promised to pay the other after a month. T-bills are a form of cash equivalent and they are our asset. So our assets will increase by 500,000 and he paid 300,000 in the form of cash. So our cash will be decreased by 300,000. On the other hand, he promised to pay the other 200,000 after a month, and that forms into a liability of 200,000. So if we solve this, 200,000 is equal to 200,000 and the accounting equation is balanced once again. Moving to the sixth type of equation, that is making a cash payment to settle a liability. We'll continue the example that Mr. A paid the remaining 200,000. So if we continue this, he had a liability of 200,000 and which is now paid off and settled. So we'll decrease the liability by 200,000 and the payment is made in the form of cash or cash equivalents, which indicates a decrease in assets of 200,000 and the accounting equation is equal once again. Moving to the next type, that is sale of an asset on cash. So now here comes another concept of revenue, cost and profit. So we'll slightly touch the concept that revenue is equal to cost plus profit, which is a simple concept that we'll obviously sell the asset or product or services more than what we paid for when we obtained that. So there will be obviously a profit, which is the aim of a business to earn the profit. So we'll say that Mr. A sold goods of rupees 500,000 which cost him 450. So it means that he has a profit of 50,000. So we'll see, and this 450 is also called cost of sales or cost of goods sold. Mr. A received 500,000 as cash. That is an increase in asset, and he sold the assets worth 450. Assets are inventory, so the inventory cost him 450,000, and the 50,000 he obtained as a profit will go to the capital or the owner's share in the business, that is 50,000. Moving to the next part, that is sale of goods on credit. We'll take the same example. Mr. A received 500,000 as cash. 450,000 is the liability, because we'll take the same example. Mr. A sold goods that cost him 450,000. That is a decrease in inventory, and inventory is an asset. So there's a decrease in our assets. The customer has to pay him 500,000 now, and a customer who has to pay is our asset, which means we can say that he is a debtor. So he have to pay 500,000 now, and the same 50,000 goes to the profit, that is capital. Moving to the next type of equation, that is receiving payment from debtors. We'll continue the example that Mr. A had some debtors and he received the payment in cash. So Mr. A received 500,000 in cash, which is asset, so the cash part of the asset is increased. and debtors were our asset which are decreased by 500,000 because they are paid off. So once again the accounting equation is equal. In our exams we can ask two type of question. Number one, that we will be given some transactions and the examiner will require to show that transactions into accounting equation like we did in the previous examples. Or the examiners can ask by giving us an equation like this, and he'll ask us that according to us which kind of transaction has been occurred. So we'll simply see that what is the effect showing on accounting equation, and we'll then describe the transaction. In this case we can see that there is an increase in cash and decrease in debtors. So it indicates that some debtors has paid us money, and we'll say that rupees 500,000 received from debtors. So that is the end of our lecture today. If you have any questions, do mention them in the comments and I'll answer you there for sure. If you have any queries, you can also contact me at or on the email or contact mentioned in the description. Do like and share this video, and any feedback from you regarding this video will be highly appreciated. So I'll see you in another lecture. Thank you.